Hello, everybody. Welcome back to Beer and Money. My name is Ryan Burklo, and on today's episode, we're going to do the continuation from last week's episode, and that is around the thought about around retirement planning and the 5 items that we all care about. In last conversation, I discussed we're all trying to build assets to turn on a cash flow or an income stream later on. And oftentimes, so many of us are focused just on the rate of return aspect, and we're not actually focused on how we turn this on to an income stream and the risks associated with focusing only on rate of return. So that's what we're going to talk into today. Let me real quick remind everyone about the 5 items that I think a lot of people really care about when they get into retirement and really just maybe in general for just overall life, right? Number one, we care about the highest cash flow, right? Highest possible cash flow to live the life that we want to live. Number two, we want to pay the lowest rate of tax on that cash flow. Number three, we never want to outlive or outrun our money. Number four, we want to hit legacy objectives, and maybe that is making sure that our spouse is taken care of in the event of our premature death or even death in retirement, as well as legacy maybe for our kids, financially related, or just taking care of them. And then number five, we want to do those 4 items with minimal dependence on rate of return on the stock market, because the last thing we want to do is get into the retirement and have the market go up and down and us stressing over that. So if those are the five items we care about, we have to take into consideration a couple of items: taxes, and we have to take into consideration how reliant upon we are on retirement. So let's jump into taxation. And so I'm going to share my screen here real quick and go over what I mean by that. So as we look at the screen that you're staring at here, we've been working with this client. This is a fictitious client, although I think this happens with a lot. A lot of our people we first sit down with look like this, where they're making good money. They're saving a good amount of money as well. And the large chunk of their assets is in their home and retirement accounts. And so when you look at everything that I just mentioned, right, they're building these assets. Right now, they're worth $2.5 million. How do they turn on the income stream, and what's the risk associated with that, and the taxes associated with it? So when we sit down with clients, we talk about, okay, what is the tax distribution status of your assets? And that's fancy terminology of what amount of taxes are you going to pay on the income coming out of your assets? And that's a key ingredient to look at. And so what we've done is we built a pie chart where if you see red, that amount of asset or that amount of money will be fully taxable when you distribute it to yourself in retirement, or when you go to distribute it to yourself. Yellow be partially taxable, and green is non-taxable. And so when we look at this particular client, what I'm going to show you is what they currently look like now. And as you can see, we focus here on the left, current tax allocation, right? There's that $900,000. Most of their money is in a fully taxable distribution status right now. They've got another $200,000 sitting in partially, and another $100,000 sitting in non-taxable income. And then when you take into consideration where they are saving money, so if they're both maxing out their 401k, so it's $47,000 going there, and they're putting $10,000 a year into savings, and they're putting $10,000 a year into investments. And now if we look at the future tax allocation over here on the right, you can see, okay, now we've got $4.7 million still fully taxable. $1 million is partially, and the non-taxable has grown to 320. Now, the rate of returns I've got up here pretty conservative, 6%, but again, we don't want to rely upon rates of return. And if they're higher, it's only going to make this pie look just a bigger version of what it is now. Whereas if they changed, if they wanted to change, maybe they did Roth 401k instead. And maybe you don't do a straightforward change just like this, but there's 2 ways to change your future tax allocation. And that's either changing your assets, so it's asset allocation. And sometimes that causes taxation this year, so that may not be the best decision, or cash flow allocation, meaning where do you put your money to change the asset allocation for the future? So if they went to all Roth, for example, 47,000, now you can see their pie chart here has changed and changed quite dramatically. Now they have a little bit more balance in their balance sheet around what assets are taxable, partially taxable, and non-taxable. So that's part 1 of today's conversation. The second part that I want to go over is a high level example around reliance upon rate of return that I think a lot of people don't recognize. As a matter of fact, I was just going over a financial plan with someone the other day it's a prospective client, and they showed me their plan that their old advisor worked with them on, and it was really kind of based off rate of return. And what I've done is I've built it out here in this. It's not exactly the same, but it's very similar. And let me show you what I've built out here. So we've got $4 million, and the advisor had it growing at 7%. And then they're about to retire, so they'll need $250,000 of income in retirement. And then they're going to get Social Security coming in the door in 7 years. And that's going to be at $75,000. I put inflationary 3% on both of these numbers. And so as I go to look at what this looks like over time, distributing this money, you can see, well, they make it, right? So here's this little hump. Then you get this little hump right here where you get the Social Security kicking in, which is why it goes up, but then it goes back down again. And again, it's because the inflation on the 250 is quite high at this point. And it makes it all the way, right? You're 30 years from now, so they're 90. They've got $1.8 million, almost 1.9. Now, if they didn't get 7%, what happened? So if they just got 6% instead, okay? Looking at this again, and now you can see it's drastically different. They actually outlived their money if they made it to age 90. Now, realistically, would they actually outlive their money? No, they would actually start pulling back and not spending as much money, or just change what they were doing. And the question is do you want to live life where you're reliant upon the market to make or break you? And that's when most people, at least working with us, they say no, they don't want that to happen. And so it goes back to how are you setting up your balance sheet? If you have your balance sheet set up that you're not reliant upon the market, now you can do different things. And what I did as a simplistic example of this is we took $1 million from the 4 million and we turned on a guaranteed income stream of $80,000. Okay, we also purchased some life insurance that builds some cash value, and that cash value is accessible to the client. Now, life insurance, again, is specifically for life insurance, right? If you die, it pays a death benefit. Okay, but also some whole life insurance can build cash value, which is an asset inside of that policy. And what I'm about to show you is how this works out. So we're paying $28,000 a year for the whole life policy, and we're paying it for 14 years. Well, what does this do over time? So now I'm going to show you what this does. Right? Here's that 6%, right, where you run out of money. And what we've done, as you can see here, they don't run out of money now, right? The reason this is drastically lower than this is, again, keep in mind, we took the $1 million and we purchased an annuity that turned on a guaranteed income stream. But look how much easier life is along the way, right? They get down here, they're not running out of money at age 90. Matter of fact, they still have almost $2 million, 1.6, 1.7 million. The lighter blue here is the cash value built inside the policy. And the other thing they've got sitting on top of everything is this thing called a death benefit that the life insurance is providing. So all along the way, they've got protection where if the spouse passes away, there's another $770,000 landing on the balance sheet. This allows them to do different strategies because when we have a promissory note coming our way, we can leverage our assets and maybe turn on some guaranteed income streams and not worry about that because of what we've set ourselves up. Now, this is at the 6%. If I go back and let's just say, the optimists and a lot of people say, well, what if I get the 7%? Okay, so if you get the 7%, right, here's what it was, 1.8. And our strategy that we did, okay, well, now you are a lot more. You're pushing $4 million, right? So setting up your balance sheet is key. It's not always about what your net worth is how you set your balance sheet up so that you can turn on an income stream in retirement in the most flexible way where you're not reliant upon the market and you're not stressing about the market. So I wanted to go over that with you today. It's a very high level example. 2 takeaways. What taxes will you pay on the income stream that you're turning on, meaning the assets where you're putting your money today? What's the taxes on that when you turn on the income stream? And B, how have you set your balance sheet up so that you're not reliant upon the market to make or break you come retirement? I hope this episode is valuable. If you have any questions from today's episode, head over to beerandmoney.net, and at the top of that page is a contact us. And that is a spot where you can ask us any questions from today's episode. Or if you've got a question on your mind that you want us to talk about, email us via that contact us spot, and we will look at answering that question. Hope today's episode is valuable for you. Make it a great day.
This podcast is for informational purposes only and is not to be construed as tax, legal, or investment advice. Although the information has been gathered from sources believed to be reliable, please note that individual situations can vary. Therefore, the information should be relied upon only when coordinated with individual professional advice. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Quantified Financial Partners, and opinions stated are their own. Guardian, its subsidiaries, agents, and employees do not provide tax, legal, or accounting advice. Consult your tax, legal, or accounting professional regarding your individual situation. All investments and investment strategies contain risk and may lose value. This material is intended for general public use. By providing this content, Park Avenue Securities LLC is not undertaking to provide investment advice or a recommendation for any specific individual or situation, or to otherwise act in a fiduciary capacity. Please contact a financial representative for guidance and information that is specific to your individual situation. Ryan and Alex are registered representatives and financial advisors of Park Avenue Securities, LLC. OSJ 200 Market Street, Suite 1850, Portland, Oregon 97201. Phone number 503-221-1226. Securities products and advisory services offered through Park Avenue Securities, member FINRA, SIPC. Financial representatives of the Guardian Life Insurance Company of America, Guardian, New York, New York. Park Avenue Securities is a wholly owned subsidiary of Guardian. Quantified Financial Partners is not an affiliate or subsidiary of Park Avenue Securities or Guardian. Ryan Burklo, CA Insurance License Number 0K24924. Alexander Collins, CA Insurance License Number 0H24806.
7793673.1, expiration date March 2027.